this is where mainstream media has not caught on. It's not just about decoupling, de-risking by the West. The Chinese are doing it. She is decoupling not only from the West, but from the Deng Xiaoping model that was accepted by everybody there. So, always remember with Xi Jinping, political ideology prevails over economic pragmatism. So that's another reason why we are, pretty negative on China.
On today's episode of the What the Finance podcast, I have the pleasure of welcoming on Nick Glinsman, who's a co-founder at Malmgren-Glinsman Partners. So, Nick, thanks so much for coming on the podcast today.
My pleasure, Anthony. We've been in quite a bit of demand, but we're a bit choosy sometimes on who we go on to. So it was a pleasure, and I saw that you were based in London, so I have to, don't I, with this accent?
Yeah, exactly.
Exactly.
I'm
And
happy.
we picked a good day, didn't we? Fed. So that was a good day.
Yeah, exactly. For anyone listening back, so this is going up in a few days, but it's just after the FOMC meeting, so probably like an hour, 30 minutes afterwards. So yeah, I guess my first question, Nick, from your perspective, what is your opinion on what you heard Jay Powell say?
Well, I'm a little bit confused. I mean, it was a super hawkish statement. You basically got now the terminal rate according to the dot plot, which has just gone like this, at 5.6%, with 3 above that, right? You also have inflation stickier for longer, and you have unemployment low for longer. Now, I think Powell made it clear that they're looking at core inflation, i.e. core PCE, and they're looking at the strong labor data. And I've always maintained the fact that they can only get this inflation down, and core has been very sticky, and for a variety of reasons, they can only get it down, with a recession. And this talk of a soft landing is, I think, very misplaced, because the odds of getting a soft landing, it's incredibly difficult. Now there's talk, of course, of the immaculate recession avoidance. And I think if that is the case, then the Fed haven't done their job, basically. I also saw a discussion this morning with which I completely and utterly disagree. So this Fed has a credibility problem, because back in as the pandemic was going and then inflation started kicking in 2021, team transitory at the Fed, and there were team transitories, at the ECB and the Bank of England and everywhere else. Team transitory at the Fed was led by Lael Brainard, who was considered the prima donna of economics at the Fed. That was a mistake. It's been proven to be a mistake, and they should have started raising rates slowly, but in the middle of 2021. Okay. By the way, the other mistake, central bank error, for which Lael Brainard is responsible, is as vice chair, she was responsible for bank regulation. What have we been through earlier this year? Regional bank crisis, which has calmed down, because I think the regional banks, only a few would have concentration risk in commercial real estate, whereas I think pension funds and insurance companies have got the bigger problem. So there's been 2 big mistakes. And by the way, Lael Brainard then gets promoted upwards, which is typical. And I think there was pressure to pause. I think the markets were there, and they needed another week of work to get the markets ready for another hike. Because I'm sitting here going, if you're forecasting another 2 hikes minimum, why didn't you go? Why waste the time? Banking situations calm down. You're not hiking before the summer pause. That will be July's meeting. So why didn't you go? So I'm somewhat, Powell bemuses me, and he always walks back. Yeah, you see, look at it. NASDAQ is now up. And the S&P is almost flat. But I look at it as risk always buys the market after Powell. So he's not very convincing. He usually has his file of notes so he can answer various questions. I tend to look to Waller in terms of direction. I think they're not hiking today, even though I mean the dot plot is extraordinary. The majority is that at that higher level, okay, 560 with 3 above. I mean, you could see it's as clear as day and night. Which begs that question: do it now. So I think they're a bit like this, hoping that that the sticky part of the services side is the rent, hoping that starts to kick in. They don't know how long the lag is between raising rates and impact on the economy. They've admitted they've got no idea. So I'm a little flummoxed by that, their process there. It just doesn't make so much sense. Financial conditions have eased in terms of, risk has been rallying. What's oil doing? Oil's down there, but metals are up. Sorry, I'm just looking at the Bloomberg. It's a strange message. And it's a strange approach. Some people think it's logical, and I thought that was the case. And then I saw the dot plot. Like, okay, you got 2 in there at least, and you've got 3 well above that. You should have gone today. Then waited over the summer. Okay, that's the point. You wait over the summer where you miss a month for the meeting. So it's all a bit, I think, bemusing. And I think if they pass in July, I think you may start to see some dissents. The other thing I would stress very, very firmly is there's been a couple of discussions about, you can hear my parrot in the background? Okay. She hears me speaking English, and then she starts to come out with a few tunes that the English would know. But you've heard a couple of comments over the last couple of days that the Fed should be adjusting its inflation target. They cannot do that. They've got to hit 2% first. If they adjust it before hitting 2%, goes their credibility completely. So, I mean, market reactions, like we're seeing today and that we've seen before, tells you they've got a credibility gap. So I may be sounding quite harsh on the Fed. Fed's got one job. It's not there to please people. It's there, if McChesney Martin, it's there to take punchbowl away. And, what is the problem with boom bust? That's our norm, is the boom bust. Smooth it out a little bit, but the balancing act on boom bust is usually fiscal. However, this is where I suspect the Fed has put the brakes on this month. There's quite a lot of treasury bills and cash management bills to be issued, catch up after the debt ceiling. And, to me, that combined with, say, in Europe, you've got the TLTROs, I think it's about 426, 450 billion euros going to be paid back. You've got the Bank of Japan less active in the market at the moment. So take those 3 banks, Bank of England's QT, Fed's QT. There's a rather large sucking sound going on in the market right now in terms of liquidity. So it would still surprise me if we get continuation of the risk rally, given how much liquidity is coming out of it's anywhere between $1 and $2 trillion over the next several months. Okay, that's an enormous amount of liquidity being sucked out. Think of a vacuum cleaner. So that's something I think is a very big risk that people are ignoring. Some people were buying commodities today on the back of, or metals today on the back of the China so-called stimulus. It's not a stimulus. Whatever they do now is to stabilize the real estate market. And I don't think China comes to the rescue of the rest of the world because, well, let me put it to you this way. From a macroeconomic perspective, they weren't going for the high-end consumers, the ultra-wealthy. They weren't going for the rural consumers. They were going for the middle class. Okay. So the middle class have just been through COVID zero with no healthcare system and no social welfare system. which is what communists do. It's not a socialist, it's a communist. They just also lost 40 to 60% of the value of their biggest asset, real estate, their house. So you've just been through a situation where you had no work to do, you weren't getting paid, there was no national health system, so you had to pay for medical help if you could afford it, and there was no unemployment. And then you just lost 40 to 60% of the value of your biggest asset. There was never going to be any revenge spending. The domestic consumer was always going to disappoint. And I think that's where there's a misconception in the market. And that's why I am very bullish the dollar against the renminbi. They're going to have to go back to exports. They're going to have to let the currency devalue. Actually, anything against the renminbi, but dollar in particular. Yen against the renminbi, euro against renminbi, euro could suffer a bit because that's one of their biggest competitors, okay, in the export market. So CFETS is making new lows all the time, as is, So I think that was pushed. I think at some point this year we'll see a break of 740 and head higher. We're currently at post-Fed 717 and a quarter. We put that trade on in beginning of February at 677. And some of our clients say, well, should we take profit? Why? Why would you take profit? And especially if you put it on nicely with low volatility on the currency side, there's no need to take profit. You may want to delta hedge occasionally, you may want to hedge it a little bit, but you're only doing, if the move is, you're only hedging these little moves. Okay, it's quite simple behavioral economics. So as this, given that there's now a lot of buzz about quote unquote stimulus, which I think is more stability, it's done nothing, Chinese currency. So I think, and then I look at Europe, and we're going macro here and thinking about currencies and dollar. I look at Europe, and a lot of people think a lot of European money is hidden in the US equity market. And when it goes back to Europe, the euro is really going to rally. Okay, that's fine. You got to respect flows. I don't see it so much. I see more a case of we've had basically an official 2 quarters negative growth, albeit insignificant. The US is outperforming Europe. It has much more flexibility to outperform Europe. Even the UK has flexibility to outperform the European Union. So I don't see it. I don't see how the Europeans get out of this morass, and especially, typically if the central bank is hiking or cutting rates, you would think about, okay, what's the reaction I've got to do? What's a normal reaction? But I've got a feeling that this hike coming tomorrow from the ECB is not a good thing, okay, because the economy is slowing. The thing about the euro and the ECB is how much have the Bundesbankers taken control? So you've got Nagel, who's head of the Bundesbank, and then you have another German, Isabel Schnabel, very hawkish. But they're not the only hawks. Austria, Finland, the Czech Republic, the Baltic states, it goes on. So if they've taken control of the process, then, okay, you buy the euro because it's going to become like the Deutschmark. They don't care about the economic consequences of crushing inflation. That's what they will do. I somehow think it may not get that far. Okay, it is a political animal. So that's sort of my macro view. Emerging markets, some people keep saying to me, you got to pick and choose. So on the flip side, people are buying Brazil for the positive carry. People think country's open for business. It's not. It's become very protectionist and even more protectionist than usual. I get stuff sent to me from the US or the UK. Used to come in, prepaid the import taxes. It's with me within a couple of days of arrival. Now the average is 2 months. And you know, and that coincided with Lula taking over. The other thing is, BRICS Plus, it is a disastrous idea. Brazil, like South Africa, is a commodity exporter. So it is inalienably linked to the dollar. Has to be, right? India, for example, will never delegate control of its monetary policy to the Chinese. No chance. Absolutely zero chance. China and Russia can do what they want. If I was thinking about Russia, I recently read a book called Putin's People. It was talking about the history of how Putin came from St. Petersburg as deputy mayor all the way up to being president of Russia. And if you think of one of the reasons he actually became president, was he was supported by the Russian Orthodox Church and the White Russians, particularly the expat White Russians, who were looking to regenerate imperial Russia. Now Putin's at a vassal state of China. That's not the most stable situation either. So back to Brazil. Brazil's inflation has come right down. There's been a lot of central bank bashing by Lula. Now, if I look at Brazil cutting rates to reflect the central bank, the inflation rate falling, the positive carry gets less. The argument is that you buy the euro because the Europeans are raising rates first. Okay, so flip it. Now there is still quite a lot of positive carry, but I think the risk environment is questionable still. So would I do that? Not so sure. And there are other reasons politically why I would avoid a full exposure in that sense. So that's my trip around the world. I hope it was clear and done with clarity, because that's important. Because otherwise, you end up talking so much, people get lost in the journey. But I think I did. Well, no, I went US, China, back to Europe. But anyway, it was okay.
Yeah, no, it was really interesting to hear your thoughts on, I guess, the whole global sphere. So if we go maybe back to the Fed to start with. So as you said, there's in the dot plots, which is, I guess, the predictions of all the chairs and what they think rates are going to be in the future. They're saying that they think there's going to be hikes. And from my perspective, I think this is what the market probably agrees with as well, is they're thinking that it's done and that their next step will be downwards. We're not sure when that will be, but maybe when something breaks, when inflation continues to fall further.
I'm sort of uncomfortable with that too. I think they'll be higher for longer, and I think that's a mantra all the central banks are going to do: higher for longer. Will they actually raise rates again in July? I think the dot plots are setting up the market for that. It's primarily the equity market that doesn't believe it. The bond market has bearishly inverted further today. So if you look at 2s, 10s, we got to as high as 92 plus basis points. We're at 91. That's quite a stretch. So I tend to feel that, said with a bit of knowledge, Powell doesn't mind having a recession. Okay, so Powell and Waller, I guess you include Bowman and Kashkari and several others, and Bullard, who's not a voter at the moment, they're okay with causing a recession to get the inflation down. Otherwise, you may end up with inflation between 3 and 4%. That's not a target. And then people will say, well, let's change the target. How can you change the target, retain credibility? You can't. You just can't. So they're trying to rebuild their credibility. What does that entail? Higher rates, I think, or certainly higher for longer, and perhaps one more, even 2 more rate hikes per the dot plot. I mean, that's quite a consensus, the dot plot. The majority of FOMC are 560 or higher. That's extraordinary. Actually, that really is extraordinary. Especially when you look at the tilt politically, 3 strong FOMC members, Republican, like Clarida, for example, were ousted last year in favor of more Democrats, whom you would imagine would be more dovish. And it looks like that's not necessarily the case.
Yeah, and you said that the equity markets are the sort of the only market, or one of the only markets at the moment, that don't really believe the Fed that they're going to continue increase interest rates. So do you think that's really where the risk is at the moment, that especially those high risk equities that you're talking about?
I think it is where the risk is. I think a lot of people have just given up on shorting it, and you need that. You need the market to be net long before it can go down again. Okay, which will cause a bit of a whip in the bond market and short covering. But so I think that's the case. It's been a very narrow rally with these mega techs. This week has seen a broadening out of that rally, but that's just the short covering. So I'm just patient. What I try to do when I'm trading a portfolio is, unless it's really obvious, I stick to the bond market. It's cleaner. It's been quite volatile, this year, but it is cleaner and gives you better signals. It's sort of a similar trade, but it's something you can think about and be logical about. I can't, I have trouble talking to equity specialists, like, and they have trouble talking to me, by the way, But there again, my professional life has been looking for problems. As a macro person, you're always looking for problems. So, but I think there will be signs as and when the equity market's ready to take a breather that could be 10, 20% down. And who cares, given how much it's gone up this year on climbing the proverbial wall of worry. I think actually where I think there is an exposure on the downside is the metals market. Because if they've been bought because of China and China disappoints again, they're long and wrong. So, we've been short copper for quite a while, using COMEX, well above the 410 level. And it's back up to 385, but it's been those 365. And, that's not our pure position. You can sell puts at the bottom just to take in some extra revenue out of that trade. And we know where we'll cut it, but I think those metals could be very exposed, if China disappoints, which we fully expected to do so.
Yeah, and that further links to those countries that you said that are quite exposed to commodities, such as, I guess, Australia, Brazil, South Africa. And those other countries could be affected.
Yeah, exactly. That's exactly right. It's sort of commodities are fascinating because they are quite macro mixed with geopolitical. So that's where the world is fusing together at the moment. Okay, macro and geopolitical leading to your market consequences, and the commodity space has got it. I think the bond markets usually get it, but it's the equity space. You're always battling this sort of, for me, 0 days to expiry options is one of the craziest things I've ever seen invented for the financial markets, because that's pure casino. That's just punters. And if you look at what the origin of the word punter, it comes from the Latin to gamble, puntere. Okay, it's a strange thing. It's a strange thing. But yeah, that's my thought process. I don't think we're out of the mire yet, and I think China could be very problematic. Remember also, the last time Chinese allowed the renminbi to devalue, there was a real shake in risk. So we have to watch out for that.
So So listening to what you're saying, sort of next 6 to 12 months, you see that there's going to be probably, the Fed aren't too fast if they push the economy into a recession. There's going to be that fiscal support as well, so that might balance out why they're trying to
huge fiscal spending, right? And you know, in the old days, back in the Greenspan era, fiscal was spoken about a lot more. More fiscal, we're going to be tighter for longer. Less fiscal, well, you know, not spoken about at all now. And I think it has to be. You know, I think it, you know, huge fiscal. Huge. At the moment, I don't see any Republican candidate that could possibly. Well, I guess DeSantis could be fiscally prudent because he has been with Florida, but I haven't heard it on a national level yet. So I'd be interested there. But you know, otherwise, everybody else is just, you know, issue the bonds, spend the money.
Mm. So where is the opportunity from your perspective then, as you said, that you're saying that the US against sort of Chinese yuan, is it just really picking those battles and finding those opportunities, as you said, where there's going to be this reversal of those trends because of it could be changes in fiscal policy or monetary policy?
You can definitely, doesn't have to be in the foreign exchange market, dollar renminbi, but you can replicate that trade by either being, you know, being short some of the metals. It's the same trade basically. I guess even short the Aussie. I don't want to offend, but you know, it's possible that could be. I don't think that's the best expression, to be honest with you, because if China is having a bad economic period, it's not necessarily good news for Australia. Would I be long equities here? I'd certainly be hedged if I am long. And actually, hedging is cheap. The VIX is just above 14. So, you know, volatility is cheap. I mean, it's crazy that it's so cheap, given how we've gone with equities. I think what I would be doing in the bond market would be buying what they call a barbell. I'd be buying the short end and the long end, duration weighted. So I'd be long, you know, the high yielders that are giving me, let's take the 1 year, just under 5%. And then I'd be long, you know, 10 or 30 years. 10 year is 380, 30 year is 388. So, you know, I do that as a barbell. I think that's good, because they will crush them. They will get inflation down. If they don't, you know how it's going to work out. So you'll just have to get rid of your long bonds accordingly. What else do I think? Don't tell too many people. I quite like the UK. People like to dump on the UK. And
that's your contrarian coming out, I think.
Well, a little bit. I know. I mean, people who live there are always negative, right? I remember being negative for many years. But from afar, it may not be such a bad place. Currency should be doing fine because you know, the rate differential is good for the currency. And they've avoided a recession. Is there a signal? I mean, I'm hearing quite a lot of tech companies negotiating with the government to move their European branches there. Okay, so I just think sterling may be okay. Look, when you had the Liz Truss thing and it was cratering and people say it's going to go sub 1, whenever sterling goes near 1, near parity to the, you buy it. Historically, you always buy it. You know where you got to get rid of it, you buy it. So we're still long. And, you know, we're making new highs at the moment. So, yeah, I've got this little feeling that they're going to boost the economy ahead of the election. They'll do a lot of stuff to boost. And somebody said to me, well, what about stagnation, stagflation? I said to them, stagflation historically only happens with the Labour government, which we could get, right? But historically, it only does. Go back to the last example was the 1970s. It was the perfect example for me. So history rhymes and history gives you a lot of clues as to what's coming down the pipeline. So you have to be a student of economic history. No doubt in my mind. So yeah, I think there's going to be problems with European debt. There's a lot to roll over. And you have to remember, I worry about the banks. I mean, I worry about some comments coming out of the ECB as well. Enria, who's responsible for, I think, the financial stability side of the ECB, came out and said the losses in Europe are not as big as the losses in the US. I'm sitting there going, you've got a market that was buying stuff at negative yields. What are you talking about? I actually wrote this on Twitter, of all places, probably indiscreet, but I said, looks to me like Enria is speaking his truth in a similar fashion to Prince Harry. He's the Prince Harry of the financial sector. I mean, how do you come up with that sort of comment? Because you have to remember with the European banks, not only have they got this big exposure to the European bonds, which they should be marking to market in accordance with Basel III, but they've got an even bigger government exposure because all the loans they made to the small companies during the pandemic were guaranteed by the governments. Now, is it complacent to think that the spreads between German bonds versus BTPs is at 169 the last time I looked, whereas recently it's been above 200? There's a lot of faith in all this. I think a lot of complacency. So I could be wrong, and I'm not going to get it in the way of that steamroller. I'll wait till it turns and then get that trade on. But have to be a bit careful. Don't get it. My biggest advice to anybody is don't get in the way of the steamroller, because that steamroller is going to give you clues as to when you should get onto the particular trade.
Yeah, that's a great piece of advice. And I think maybe they're saying that because they haven't raised interest rates as quickly. So maybe that's why they're saying there aren't as many losses. But yeah, as you said, there's more debt.
And also, if they're going to be aggressively raising rates, how on earth, the carry on some of this European stuff is going to be terrible. So I'm quite dubious about it. I think the French bond market's also expensive relative to Germany. Has widened out in the last year. I think it's gone from about 25 to 54 or something like that in the 10-year sector. It's got more to go. And the other danger for Europe is the Japanese still hold quite large exposures. Mrs. Watanabe, that investor, okay? Now, if the Bank of Japan finally accepts that inflation has returned and they get rid of yield curve control, or they raise the band, that could create a lot of money returning to Japan. And where it's going to come out of is European bonds, also Brazilian bonds. Do you know why Brazilian bonds? This is a fact that not a lot of people know. The largest expat community of Japanese resides in Brazil. So they're very familiar with the Brazilian financial markets. So I think there's some exposure one can watch. If the Bank of Japan does change its yield curve policy at some point, which I don't think will happen until after what potentially could be a snap election by Kishida, but if it does happen, then you're going to see some quite significant dislocations occur.
Yeah, definitely. I didn't realize that. That's quite a interesting fact. So, if we go back to China, and obviously you said that you're short their currency against the US dollar, and you also said before that you're quite bearish on, I guess, on the real estate market, and then if you're short copper, China.
I tell you what. Okay, so we do have decoupling and de-risking. Now, people look at that as being a US-led thing. Chinese are decoupling aggressively. Okay. As a fiduciary investor, and if you're part of the rule, from a country of the rules-based order to the West, plus Japan and Australia, etc., you have to ask yourself, will you ever get your money out? So I'm going to give you a couple of anecdotes, but let me first talk about Chinese decoupling. So we always felt private equity and venture capital were the first areas to be really exposed and feel this. Chinese on April 26th changed their espionage law, thus making due diligence a spying offense. Okay? Now, the person that's been, she also, the state security, it's called SSA, State Security Administration, that is the equivalent of a combined FBI and CIA. Person in charge of that, Chen Shixin, has been put in charge of watching, watching American companies and acting accordingly. Since the change in the espionage law, these consulting firms, Bain, Mintz, Capvision, have all had visits from the State Security Administration. And I think Bain, 6 of their employees were detained, one of whom was a Singaporean, not Chinese. This means that due diligence is no longer legal. We're aware of several fund managers pulling their staff out of Hong Kong. Don't differentiate between Hong Kong and China. Hong Kong is now part of mainland China, period. We know that I've also heard, for example, a venture capital fund, a friend of mine has been involved with. They had an investment in the Chinese IPO that they bought, I think a year ago, just over a year ago. In the documentation, it was just like your standard IPO. In a year, your restrictions are released and you can sell. The venture capital firm went to sell. The Chinese Securities Administration said, no, you can't sell. They said, well, hold on, it's in the documentation. We've decided you can't sell. So you're not guaranteed to get your money out of there. So anyway, so due diligence is done. I'm hearing a lot of fund managers are now no longer happy to send any of their staff to China for visits, okay, company visits, so on and so forth. And in fact, the US State Department has a travel advisory warning American citizens, if you travel to China, you could be detained or arrested without access to consular services. That came out after the espionage law was changed and modified. So that tells me that China is actually, that wasn't a retaliation to anything. We're expecting China to retaliate to actions by the US. We're expecting a reverse CFIUS, whereby the US, in certain instances, and this will be via an executive order first, wants to review outward investment and ban investment in supercomputers, AI, and that sort of technology. Now, the reason why there's an executive order it is preferred at the moment is Biden doesn't want to go full on against the Chinese. They could disrupt supply of rare earths for the green environment, technology, etc. But he's also trying to quell a bipartisan Congress. It's the one area both sides agree on, China. And you'll see that come through as we approach election time. So now that seems to have been delayed, the executive order. I've read in the Asian Nikkei Times, because they're concerned about supply of rare earths. Funnily enough, I'm a little bit more cynical than that. I tend to think that it's not just that. Why would they need to do an executive order that controls and stops certain technology investments from the US into China, which affects private equity and venture capital, if the Chinese are doing it themselves already with the espionage law changes? So I'm wondering whether that's connected. Oh, well, we can ease off and let Congress go and do their thing over a period of time, which will take a while. And have no doubt Congress will do something much more restrictive. Think about this. In the House of Representatives, there is a committee for China. Mark Warner he's on the Senate's Intelligence Committee, and has been worried about what's been going on the minute Xi became president. And in his words, it's got worse. So we may see a little bit of a delay in the executive order. We may not, but I suspect it's delayed because the Chinese are doing it themselves. And this is where mainstream media has not cottoned on. It's not just about decoupling, de-risking by the West. The Chinese are doing it. Xi is decoupling not only from the West, but from the Deng Xiaoping model that was accepted by everybody there. So, always remember with Xi Jinping, political ideology prevails over economic pragmatism. So that's another reason why we are, pretty negative on China.
Yeah, it makes sense. And as you said, it's crazy how many strides both countries are making to sort of decouple, not just US and not just China. So Nick, thanks so much for your time today. I really appreciate it. My last
My
question
pleasure,
is,
Anthony.
yeah, I've really enjoyed the conversation. So what is one message you'd
Thank
like
you.
people to take away from our conversation?
Well, Harold and I, produce a daily paper, and we now have a Shopify account, so you can find us on Shopify. And currently in June, because we opened it at the beginning of the month, we've got a 50% discount on the daily. And then you can also access, if you're a bigger, that's designed for institutional. It's an institutional level narrative that's available for institutions, small family offices, and retail, and registered investment advisors. And then the bigger institutional work is usually on a retainer, but there's a base price, and there's information on our Shopify store, which is Malmgren-Glinsman Partners. So that's the message I'd like to get out there, if that's okay with you. Otherwise, I would just say, be careful. Just certainly be careful of anything China related, but also be careful risk assets at this level, because not every risk asset has gone up like equities. Commodities have, right? So it's be careful also on the dollar. I think we're at the other side of the smile, so we've got more to go. Okay, so that's my view.
Awesome, thank you so much. So you mentioned your the research through Shopify. I know you said Twitter as well. I guess if anyone's finding your views, that's probably the best place.
That's correct. Twitter, you'll find me and Harold. So, and we've got quite a following combined, so that's quite good. Harold more than me, but that's because I'm sort of busy writing and interacting a lot more. I'm not aggressive with Twitter. Let's put it that way. If I see something out there, I'll mention, you got to watch this, and so on and so forth.
Yeah, perfect. Makes sense. But thanks again.
My pleasure.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.